Hi, I'm Jim Marr, and in this session we're going to take a look at capital budgeting. First up, we're going to look at net present value, a very important calculation that you should understand. And it's simply the sum of the present values of a series of cash flows. So there is our definition, and here's our formula. Lucky for you, you really don't need to memorize this. Get an idea of what's going on here. And you can use your cash flow keys, as we'll see coming up in just a little bit, to make this calculation for you. So what we're really looking at doing is, once again, summing the present value of a series of cash flows. As we can see, in this example, we have CF at time 0 or CF0, and then a bunch of cash flows coming in, if you will. Normally, our first cash flow here is probably going to be a negative. It's going to be some sort of outlay, possibly for a capital project. Now we're going to use the discount rate here of K. That's our cost of capital to the firm for our particular project. And as you can see, depending on what period we're looking at, we have our exponential right there. Now the NPV is a very useful calculation for assessing the feasibility of projects. I want to know this rule. If the NPV is greater than or equal to 0, we accept the project. NPV of less than 0, reject the project. Very, very important concept to understand right here. I could even say double star that. It's something you really want to learn as a concept. We want to be able to make a calculation up here and then also apply what we're calculating to a particular situation. So let's go ahead and dive right in. Using our example here at a 10% discount rate, I've given you a bunch of cash flows as well. And that would be our interest rate per year that we're going to use, or per time period. And we have a 4-year time span here and a various different cash flows. As you can see, there is our outlay. We're going to outlay $175 for our particular project, and maybe this is a bunch of zeros even after that. And here are our cash flows coming in from our various project here, our various time frames. We have 25 coming in at T1, then another 100, 75, 50, and so on. So we have 4 positive cash flows after we make that negative outlay over here. And the NPV is simply a change in wealth in present value terms, once again from a series of cash flows, okay? So now let's see how we're going to make this calculation on our calculator. I'll pull up our emulator here, and we're going to do our second. I'm going to clear this out for you just in case. We're going to do that. I actually did that a little bit early, but let's go cash flow, and then we'll do it. So second, clear our work. And then we're going to enter our 175. Make sure you put in a negative here, otherwise you're not going to get the right calculation. And then we're going to put in our enter. And we're going to scroll down. You see C01. That is going to be our cash flow at time 1. That was 25. Go ahead and enter that. And our frequency here is going to be one payment of $25. So you really don't need to worry about that in this example. So we're going to go down to our cash flow to 100. We're going to enter that. And we're going to scroll down. Let me go over here to my slides and move them along. So now we're going to go back to our emulator. And our cash flow in period 3 was 75. Enter that. Scroll down. Our frequency once again is 1. Cash flow is at time 4 was 50. Let's go ahead and enter that here. And now what we want to do is enter our net present value mode. And there we go. And there's our interest rate. I indicated that to you as the interest rate of 10%. I gave you that on our last screen. We're going to enter that. And now what we're going to do is we're going to scroll down to our NPV and say, hey, why is this 0? Well, we haven't done the computation yet. So we want to go to compute right over here in the upper left-hand corner, CPT. And we can see, hey, there's our net present value of $20.87. And we see that as a positive value. So what would we do here? We would accept the project. And it's actually done pretty well. NPV of 2087. Okay, so we made our calculation and then made some sort of recommendation afterwards. Very, very good example in any financial exam. Okay. All right, now we have another very important calculation that you'd want to be familiar with. It's called the internal rate of return. And really what that's all about is solving for a discount rate that equates the present value of a series of cash flows to their cost. Now I can imagine this would be extremely difficult to do without a financial calculator. It's basically the internal rate of return is a discount rate that makes our NPV 0. So it'd be a lot of plug and play to try to figure this out, right? And here's our formula for you. We have our NPV equaling 0. So we're taking all these series of cash flows that are going on over here and we're making them 0, but we got to figure out what is the internal rate of return. Now, how would we do this longhand? It'd be virtually impossible and extremely time consuming. So lucky for us, we have our financial calculator to do all the heavy lifting once again. And here is our series of cash flows that we worked with in our prior example, our minus 175. That was our outlay for our project. And then our various cash flows coming in at the different periods of time. And as you can see, they're all positive. So we have a nice situation here. We have an outlay of 175 and then a bunch of positive cash flows. So let's go see how we're going to calculate this internal rate of return. So once again, let's go back to our calculator emulator. I'm going to hit clear here, clear that up for you, into our cash flow mode. And now, oh, see, we have numbers already hiding in here. I'm going to start all over again. So let's go second, and we're going to clear out our work. So we got 175. That's our outlay. Make sure you put that negative. I can't stress that enough. And then you're going to enter. Now you go 25 here. We're going to enter that, and then we're going to scroll down, and we're going to hit our down arrow, and that's going to be our frequency of 1 once again. You don't need to change that in this example. And then 100 for our second cash flow. And now I'm going to move our slide once again ahead. We're going to do our cash flow at time 3 of 75. And we're going to hit our enter. And then we're going to go down once again to our cash flow of at period 4. We're going to enter that. And now we're going to go scroll down here. We're going to enter our internal rate of return mode by pressing the IRR key, which is right below our down arrow. And we can see that's 0. And you can say, hey, well, it's 0. Right. Once again, we got to press our CPT key up here in the upper left-hand corner. And we can see nice internal rate of return on our cash flows, 15.067. Now, you can also sort of make a judgment call here or some sort of analysis. You can see we had a positive NPV, right? And that probably would lend us to a positive internal rate of return as well. So once again, this would indicate that we should probably accept our project. So see, we can come to another conclusion. Now we're going to switch gears and we're going to look at payback and discounted payback. I'm going to go ahead real quick and here and just clear out this calculator for us. There we go. Now the payback period and discounted payback is primarily a measure of liquidity, okay? And it assesses how long it's going to take to recover the initial investment on a project. Projects with the payback periods longer than an arbitrary number of years are rejected. And there's some limitations here. It's not a measure of value. It ignores the time value of money and ignores cash flows beyond the payback period. So remember, I'd maybe want to know some of those limitations also for a exam, okay? So let's go ahead and take a look here once again at our cash flow stream. We're going to use our discount rate of 10%. We're going to analyze this using our payback and discounted payback. And we're going to calculate the payback period and discounted payback period. And this function is only available on the BA2 Plus Professional. So if you do not have this calculator here, it's not going to work for you. So let's go ahead and make sure you have that calculator. And I would highly recommend that for your exam. As you can see, that's the emulator we have been demonstrating throughout this particular session. All right, so let's go ahead now into our cash flow mode. Let's go over here to the emulator. So cash flow, we're going to clear everything out once again, and then we're going to enter from scratch. And you always want to do that just to make sure you're starting from scratch. And I'm going to go ahead and go through these pretty quick. I would, whoops, yeah, see how easy it is to scoot by one? So there we go, our 25, and then we want to go down to our cash flow 2. And we have our 100 once again. And then we're going to press our enter. And then we're going to go down. And let me go here to our slide and move that ahead. And there we go back to our emulator and go our 75. And we're going to enter that as our cash flow for period 3. And lastly, once again, our 50 for our cash flow at period 4. And then you want to then scroll down and see here, once again, the frequency shows 1 for your 4th cash flow. But we can go right here to our NPV, and then we're going to enter 10% as our discount rate. We're going to hit enter, and then we're going to scroll down, okay? And you can say, hey, Jim, I don't see that NPV number. Well, guess what? We're not looking at that for this particular calculation. We're going to go down here to payback, which is the PB function, and then you want to compute that. And what does that come up with? 2.67 years is the total time of payback here. And then lastly, we want to look at the discounted payback period. And as you can see, we're just going to come over and press the down arrow once again, and we're going to compute that. And we can see we come up with 3.39 years. So how do you get good at these calculations? You know, got to practice, change some of the numbers. Maybe you make one of the numbers in the cash flows on negative and see how that relates to it, or make a series of cash flows the same amount of numbers. But the more you practice and the more you work through these calculations, the more it's going to become second nature. So take care, and we'll see you again next time.